What's up, guys? All right, you want to see a breakdown of a self-storage facility deal. Now, I'm not talking about one that was done 10 years ago. I'm talking about one today in this market, high interest rates, and you want to see what it looks like. So what did this deal look like? How much is it going to make? How did they find it? What are the details? Well, that's what we're going to do today. Today, we're going to break down a deal and we're going to hit on all the important things and show exactly how much this deal is going to make and what it looks like. Hope you enjoy this. We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others, because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank, it's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. All right, first, for those of you that this is your first time seeing this, I'm AJ Osborne, and I have built a self-storage company of over $350 million. Started out in very small storage facilities, third-tier markets, very far from any beaten path, and we have grown to now in 10 states. We've done everything from ground up to conversions, and our bread and butter, though, is acquiring underperforming facilities and turning them around. Now, storage is an interesting asset class, and a lot of people, this may be their first time even looking into it. Others are trying to find a storage facility. So what we're trying to do is break down a deal today, especially using the thing that I talk about all the time, and that's value add self-storage investing. It's what I wrote the 2 best-selling books on, including what the podcast is all about, self-storage income. So this is a perfect example of what we talk about all the time. I love this deal for a lot of reasons. The first thing about this deal, this is a mom and pop storage facility. When we say mom and pop, we are just talking about individual owner operators that own small deals that have bought it. Maybe it's a side investment, but they're just kind of doing everything on their own. A lot of times, these have been owned for a long time. You see, storage has really changed over the last 15 years. And when I first got in it, it was hard to even get banks to loan on it. People didn't really think of storage as a real asset class. It was kind of the side thing that people did. Obviously, that changed during 2008 and after 2008, and it got really popular due to its financial durability and how its resilience, but also its performance. So let's go over this deal and take a look at one of those, a small mom and pop deal. The initial asking price of this deal was $275,000, but it was negotiated down to $247,000. The mom and pop that owned it, they really weren't doing a whole lot. So there was no website or marketing, and they really hadn't even been raising rent. Lots of times what happens with mom and pops, they buy them or they build them and they do it cheap. And over the years, it cash flows so well, they just maximize occupancy and they don't really do anything else. And they don't need to, because it cash flows so much money. The reason why, though, it's cash flowing so much money is the basis that they went into it is just so low. So they enjoy the cash flow, but lots of times they get tired of it. They don't want to operate a storage facility anymore. And they actually want that money out of it. Why? Because they can't replace it at that, and the cash flow that they're making now is low compared to the value that has been built into it, because they got it for so cheap back in the day. Now, this deal that I'm talking about is Caleb and Elizabeth Wilson. They're members of my group. It is not my personal deal. So I've been able to watch them and watch them as they buy it, and I love seeing them be successful like this. This is the first deal they bought, and it's being ran by her while she takes care of their little girl. So let's look at some numbers. First of all, in this deal, it was roughly 84% occupied, because remember, it had no website, there was no marketing going on, it was just there. The owners optimize for doing nothing. That's what they optimize for. But as we can take a look at their P&L, it was bringing in roughly, the gross potential was $32,000, just over it, and they were bringing in roughly $27,000. Now, their expense ratio is around 17%, which left them with $6,346. So they were able to buy this at a 9 cap, effectively. Now, they worked with a local friendly bank, which I suggest. They had to put 25% down, which 25% to 40% is pretty standard in the storage world. Now, local friendly banks like the Citibank or credit unions are great for small facilities, especially in rural towns. Lots of them, like credit unions, they have to loan to that local market. And they want to. They understand it actually better than big banks do. So they're great to work with, especially on deals of this size. The debt service is roughly $16,000. So before debt service, the net operating income is right around $22,000. So what's already been done? Already on this deal, they began to raise occupancy. Why? Because they implemented a website, online presence, they started general maintenance, and they're getting ready to put in security cameras and adding additional level of services. But along with adding in their websites and their general maintenance and adding in signs, they are able to add in things like auto pay, as well as start to raise prices on units that were fully occupied. So they've immediately been able to raise their overall income. Now, we're going into the busy season, so this is all the work that they've done to get ready to go into the busy season. Now, there isn't an end to this one. We don't have complete turnaround numbers because they just got this. And they've already been able to improve the asset, not just physically, but financially. The key is there's assets like this all over the place. So you have a $247,000 asset that is cash flowing even after debt. That is less than a lot of duplexes in almost every major market. Yet you don't have tenants, you don't have toilets, and you have a lot of doors. That diversifies the risk. So you're able to actually maintain profit at a lower occupancy rate, like 84%. But here's the thing, their occupancy may have been 84%, but they were roughly 65% economic occupancy. What does that mean? What that means is, let's say you have a 10 by 10 and you're charging $100. Well, the facility, even though they can get $100 and are charging it, they didn't do rental rate increases. So people that had been from the past that went in there at $65 or $50 were still paying $50 because they just never got a rate increase. So they've gone a decade and not had a rate increase. And that means they're not getting charged what the actual unit is being leased out for. So their economic occupancy is low. You can immediately change that by upping your tenants that aren't paying the market rate, which they should be. A lot of mom and pops do this. Why? Because first of all, like I said, their basis is so low, they don't really care, and they don't like it when they disrupt people, and they don't want to take calls from people saying, why'd you raise my rate? But of course, inflation, taxes, everything goes up. But that's a value add because you're buying it on the current cash flow. You can get occupancy up from 84% to maybe 90, but you can get that economic occupancy up. And that can happen immediately, therefore improving the cash flow. And it may sound like a low number, right? $65 to $100, but you're talking about on a lot of doors, and there's low capex. The ongoing expenses are minimal. People don't live there. They're not using water. They don't have electricity. These are garage doors. So 100 doors and you increase rent by 10%, well, that gross rent of 10% goes where? Straight to your profit. That is why it's so impactful. On a facility like this, where you have $32,000, and a net profit of 6, a 10% increase changes that net profit to 10,000. That's a big lift. More importantly, that then increases the value. And that value is increased much greater than the net profit because it's a cap rate, meaning it's a multiple of the net income. So as net income grows, the value grows even more. So instead of it being worth the 247 that you bought it at, it's now 300,000, creating equity fast and higher cash flow, even though they already bought it cash flow positive at over 6,000 a month. I love these deals. They're simple, they're reliable, and they're diversified. You get lots of doors for low price, and the impact on the customers is little, but the impact to you is huge. In fact, it's life-changing. Now we have more case studies that we're rolling out, so make sure you're subscribed so you can see the next deals, and also comment what you want to see in them so I can make sure you guys are seeing exactly what you want to know about this amazing asset class. Thanks.